Welcome back to the podcast, joined as always and as usual by Ernest Wong. How you
Happy
doing?
to be here.
You're happy to be here. Me too. It's Friday. It's Apple's Vision Pro Day. Is that a product that you think, well, they're starting off with selling just like, we don't know if it's 100,000 or a few 100,000 units, but eventually, is this going to be a product that takes off? Is this going to be the gateway to AI and virtual reality and artificial reality, or a niche product that only a few people are going to use? Your take?
It's really hard to say. Mm-hmm. Apple, I will say this, Apple products historically don't fail.
Yeah.
They end up being a success. I think the Vision Pro is a little bit unique in the sense that it's totally unlike anything that we've seen in the marketplace.
You've seen all the memes online, of course. People are saying it's heavy, so you have to work out your neck because it's going to be so heavy on your head.
And there are a lot of things they have to work out. Mm-hmm. Like, for example, I think you can't wear glasses while wearing this thing.
That's why I'm wearing my contacts today. Yeah, but okay.
But I do expect over time, Apple will be able to leverage the developer base that it has, and I'm sure they will find some applications that we've never dreamed of.
I remember Ernest when I had my BlackBerry and the iPhone came out, and I said, I don't need the iPhone. I don't need to search the internet on my phone. And of course, I was completely wrong about that. So predicting the future and what the consumer will adopt is obviously incredibly hard, but I think you said it exactly right. Apple has such a huge network base. They've had some fails before, no question. I don't think, remember the HomePod? Has anybody actually bought that?
I think people do.
Okay, but I don't think it's taken off as a huge success. But we'll have to see. I mean, Apple is the biggest stock. Well, I think it's back again higher than Microsoft, or they're flirting with being the largest market cap stocks on the U.S. exchanges or in the world. These companies did tremendous last year. There's worries, of course, about overvaluation of growth this year, but still the value of the products and the use by consumers isn't going away anytime soon.
There was a good tidbit I saw last week that Apple has just surpassed Samsung as the world's largest smartphone maker.
Okay.
Which is interesting because I don't think people realize that. You see a lot of people saying that Apple's best days are over.
Yeah, all the time. But they've said that for a decade, Ernest.
Apple's matured. People aren't going to buy more phones. But then you come out and realize that they still only have just 20% market share.
That's crazy. I didn't even recognize that they only have 20%.
Well, okay. Now to be fair, like a lot of the share is of the competitors is in emerging markets where they're not paying like $2,000 for a new phone.
Okay.
But it still shows you how much runway for growth Apple really has.
You have to imagine that eventually these emerging markets, consumers in those emerging markets will want Apple products. Maybe not at the price points that North Americans and Europeans pay, but definitely they'll want those services and then eventually be able to sell them more products, more services. So I think that's we're excited to continue to own Apple here. We get some questions once in a while after we do our podcast, and a lot of people ask about, and certainly clients ask, how we construct portfolios. And also people ask, when do we actually decide to pull the trigger on a stock? What gets us there to buy it? And so maybe I thought we'd answer some of those things. So portfolio construction, what we're talking about there is, how do we build a portfolio of stocks? How many stocks do we buy? How do we figure out what stocks go into the portfolio? We've talked a lot about the types of companies we like to own, the quality, the management, the recurring revenues, the returns on invested capital. But Ernest, how do we get all those names into the portfolio? How does it work?
So our current portfolio, the growth equity strategy, it has 34 names.
Okay.
So this isn't a fixed number, but it's just a number of names that we feel comfortable in terms of our ability to keep track of the fundamentals of the companies, but also provide enough diversification to protect in case we're wrong.
Okay. I think that's fair. So about 34 stocks in a portfolio. And how do we weight them when we buy? Let's say a client starts out with us, gives us a nice chunk of money to invest on for their retirement. How do we buy those 34 stocks?
It is largely equal weight.
Okay.
So more or less each name has the same amount invested in it.
So each name has around a 3% starting position.
Right. And I there's a lot of theories out there that and research that you should weight based on the risk of each name and all those kinds of things. Mm-hmm. The reason why it makes sense for us to equal weight is because all of the companies we own are good businesses, right? We're not we don't think the risk profile of each of the companies that we own is too different from each other. So it just makes it a lot easier if we just equal weight it.
So what you're saying is we don't buy any speculative names in the portfolio, so there's no reason to give those a 1% weighting versus something that we think is safer and give that a 5% weighting.
Exactly.
Right. So when we equal weight them, we're essentially saying we like all of these 34 companies equally. We may, more or less, you and I may disagree as to,
yes.
But that's really the only way we know how to do it, right? We're not running, a lot of clients need to understand we're not running funds as well. It's separately managed portfolios. So it's very hard to fine tune exactly percentages and weightings, but that's what we tend to do. Ernest, what happens when a stock gets very big in a client's portfolio, or what happens when a stock starts to sink in a client's portfolio because it hasn't done well performance-wise?
Well, I think that's one of the benefits of a separately managed account is that you can manage these situations. If there was a stock that really ran up in an individual portfolio, like you can trim it back a little bit to take a little bit of gains and manage the exposure relative to the rest of the portfolio. And I think conversely, if there's a stock that's down, like we probably like it still, but like you have the flexibility to take a tax loss and maybe think about buying it back later.
Exactly. So we don't really have a hard and fast rule about what the percentage is, but no question if a stock in a client's portfolio gets to around 10%, God willing, that's a wonderful thing to happen. That raises the eyebrows of the portfolio managers to then take a look and decide if that position should be trimmed back, depending on capital gains, where it's held. But that's really how we think about portfolio construction. So we're buying good businesses. We think all the businesses in the portfolio are good. We're buying companies in different geographic locations and different industries. We like the Magnificent Seven, but we don't own all of them, and we don't own a 40% weighting. We try to really think about weightings of industry sectors as well in the portfolio, right, Ernest?
Yes, and that's an important point is we try to look for good businesses in a variety of sectors. I think there's some people who argue that tech stocks are better, or like Canadian banks are better, or things like that.
No question the long-term returns of software and technology and infotech and healthcare have been the best, but that doesn't mean they're the best in any one period.
Exactly. And so as it turns out, there actually are very well-run businesses in oil and gas, for example, Canadian Natural Resources. Like we think that Domino's Pizza is a very well-run business, and they're in the pizza business. So we try to have some diversification among sectors and markets as well in the portfolio.
So we're not going to talk about selling, Ernest, but because I hate selling, but buying. If we've done our research, we've debated back and forth whether this is a great company to buy for our clients, for ourselves, into the portfolio. We've worked out that we want to buy it. How do we decide to buy it, Ernest? Do we buy all of it in one shot? Do we inch into it for clients? A lot of people want to know our style on buying.
Well, I think it's important to note that if we're buying a new stock, usually we're selling something to buy it.
Yeah.
Well, like sometimes there's mergers or other things that happen, but usually we're selling something to buy that name. So it's fairly I would say is fairly like straightforward in terms of the execution. Like we'll sell the position like based on the tax circumstances and the account types that there are, and then we would buy the position. Like sometimes if the stock really runs up, we'll probably ease into it a little bit slower, but I don't think it really matters over the long run.
No.
If you're expecting the company to, like compound at 10%, 10, 15% for the next 10 years, it doesn't really matter if you're paying 2 or 3% more today.
Exactly right. So we try not to fiddle around with stock prices. We've been burned before in the past, prior to you working at Baskin, where, oh, if it only gets to this price or if it only falls to this amount, then I'll buy it. I think that ends up being foolish if you're a long-term investor. You said it absolutely right. If you're looking, if you've purchased an investment and you think your rate of return over a 5-year period is going to be double digits, if you overpay in the short term by a few percentage points, that's still not going to hurt your long-term returns. Obviously, if the stock runs up 40% against you in a short period of time, you may decide you're going to wait for a pullback. But we're not. What's the Warren Buffett saying? We'd rather be roughly right than
Precisely wrong.
Precisely wrong. So let's talk about our feature investment today. It's a company I don't think we've mentioned too many times on the podcast. It's Blackrock, ticker BLK. And Ernest, they made an exciting deal, a transformational deal. And I think we have some interesting ways we can tie it into other investments we have in our clients' portfolios, as well as talk about alternative investments. So Ernest, why don't you talk a little bit about Blackrock?
So Blackrock is one of those companies that I think everybody has heard about, but they're not really sure what it does, right? And there's a lot of like frankly false information about Blackrock out there as well.
Well, you see on Twitter, someone will always tweet and say, BlackRock controls every single company in the world. They're the worst company. It's the stupidest thing, and no one does any research about it. But I see that multiple times a year.
And BlackRock doesn't own any single family houses either.
Yeah. Okay.
Okay, but that's neither here nor there.
Okay.
So BlackRock is the world's largest asset management company. They have about $10 trillion in assets under management.
Yeah. So repeat that again. How much?
10 trillion.
10 trillion. Okay.
Yes. They are, unlike other traditional asset management firms, even like Baskin, right? Like they're not picking stocks, right? BlackRock's products are very broad-based. Like they allow you exposure to a certain asset class,
Okay.
right? So, and the most well-known example of that is the exchange traded fund business, the ETF iShares business.
The iShares business. So BlackRock iShares. Okay.
Where like you can buy an iShares ETF. They might charge maybe like 10 bips or even less.
So very, very, very low fee, and to buy the index ETF, exchange traded fund. Yeah.
And it allows you an exposure to the index.
Okay.
There are well-known indexes like the S&P 500 or the TSX or the NASDAQ, right? But then there's also more niche indices, right? There's like a Poland ETF, for example. There's like more recently, there's Bitcoin ETF.
And then there's derivatives based on,
Yes.
You can buy the S&P 500, but exclude maybe the Magnificent Seven, or you can buy the equal weighted S&P 500 or a currency hedged. Like there's no end to the different types of ways you can slice up an index and resell it as a new product for investors or institutions that are looking for a specific strategy.
And BlackRock has, I would say, them and Vanguard have really driven the revolution over the last 2 decades towards low-cost investing. There's a lot of research out there that shows that active managers, like including people like us, right, they tend not to outperform the market over time. And so a lot of people will go and say, hey, why am I paying 2% management fees for a mutual fund when I can just buy an iShares ETF?
Also, a lot of institutions use these instead of picking stocks, still charge a fee.
Yes.
So they're never going to outperform either.
Yes.
Yeah.
And so BlackRock has brought in a tremendous amount of assets over the last while.
Yeah.
And they earn a tiny fee on $10 trillion, and that's a lot of money.
And we all know over the long term, stock markets tend to go up. Bonds had a bad 2022, and but bonds tend to go up in price. Yields. So essentially, BlackRock is a toll road on a global financial industry, right? And it's agnostic.
Yes.
It doesn't care, Ernest, if we decide to buy iShares funds or BlackRock funds for our clients. It doesn't care which ones we buy. It probably would prefer we buy the ones with the higher management fee. So it's always going to work and come out with a new product that maybe has a management fee that's higher, but maybe is more targeted and suited to what we need.
Right. Yeah, I think BlackRock has always been one of those companies that I'm a little bit nervous about talking about.
Yeah.
Because the whole investment thesis is partly that it's disrupting my job and what we do for a living. But no, like, it's a fantastic business, and I'm very glad that we own it in the portfolio, and it's done pretty well for us over time.
Your job is not going to be disrupted anytime soon.
Well, that's reassuring coming from you.
So yeah, I mean, there's a role obviously for active managers, passive indexes, replacing. So the ETF, the exchange traded fund market, has grown primarily from taking asset share from mutual funds. Correct?
Yes. But what's interesting is that was the initial wave of money shifting towards exchange traded funds.
Yeah.
I think what we've seen is that people, even active managers, are now using exchange traded funds because it allows them an easy way to gain exposure to a market that they otherwise wouldn't have been able to before.
Yeah.
Right. So a really good example of that is, let's say we wanted to invest in Japan.
Yeah.
Like, let's say we were really excited about the Japanese economy. Before, you would have had to go to a broker and find a basket of Japanese stocks that you like, right? Now you can just buy the iShares Japan ETF, just one click, just the way you buy any other stock, right? So a lot of active managers and wealth managers and institutional investors who are not outsourcing everything to BlackRock are using iShares to help gain exposure to markets that they want to be in.
Interesting. And also BlackRock sells a software that allows the manager, let's say we weren't buying stocks, we were using all BlackRock products, we would use their portfolio software to figure out which funds to buy, find out the returns on the funds, all the other metrics that may be important to us, and help us build our client portfolios using their software and paying them a fee for that, obviously, as well on top.
And this is especially important for large institutional investors, like the pensions, the insurance companies, and they manage big portfolios with very specific return objectives.
Yes. We must get 6% on this portfolio forever. We don't care if we get 10, but we need to get 6.
Yes.
Yeah.
And that's what BlackRock provides to these firms.
So essentially you're outsourcing the chief investment officer role to BlackRock software, and probably with AI and data analytics, it will only get better over time. So my job may be disrupted. Anyways, so BlackRock, before we talk about the deal, you can imagine that more money is going to continue to flow to exchange traded funds over the long term. Maybe there'll be some fee compression, but that in itself should be a pretty good business. BlackRock, I think its capital allocation, Ernest, it pays out most of the cash flow in dividends as well as buyback. And the stock has done quite well over the long term.
And it's really because BlackRock is a fantastic business.
Okay.
They earn 40% margins, operating margins. Yeah. And there are scale benefits to what they do, right? Me and you cannot launch an ETF for 10 bips.
Nope.
Like, we just can't cover the costs of it.
Correct.
Right? You need the trillions of dollars that come of assets that they manage to be able to spread over the expenses.
And they have the name, and they already have the distribution platform, which is a gigantic moat in and of itself. Okay, so BlackRock, it has that business. That business is running on full cylinder, doing great. And then all of a sudden, Ernest, 2 weeks ago, they announced a gigantic deal to get into the alternative asset business. Tell everybody what they're doing there and why they're doing it.
Well, this deal was not an entire surprise because BlackRock had previously said that they were looking for big deals. And it's important to note that this is not BlackRock's first big deal ever.
Yes.
CEO Larry Fink, or chairman, he has basically built BlackRock on big deals. There's been a couple of them in the past, and they've all worked out tremendously.
The iShares business is one that has been, some call it the best acquisition in financial services history.
Right. He bought it from Barclays
Yeah.
in the financial crisis when they were looking to break up.
Yeah.
It was a very prescient move in hindsight.
I think iShares at the time had assets under management of a few $100 billion. Now iShares has assets under management of multi-trillion dollars.
Exactly.
So amazing deal. And it's not like the growth is over. That's going to continue.
Yeah. So at the time, I think that the management of BlackRock could see that ETFs were the future of asset management, and they took advantage of the largest platform to do that.
Yeah.
So back to the deal. Was it last week or 2 weeks ago?
Yeah, whatever.
Oh,
Yeah.
whenever. BlackRock announced the acquisition of a company called Global Infrastructure Partners.
Okay. GIP.
Global GIP, right?
GIP.
Do people call it GIP?
I don't know. We can call it whatever we want. No one's going to tell us if we're right or wrong. Yeah.
So Global Infrastructure is a private equity firm that focuses on infrastructure.
Yeah.
I think they own like the Sydney Airport. They own a couple ports in Australia.
Yeah.
They own Gatwick Airport in London. So, big infrastructure projects.
And how much money do they have under management? About $170 billion or
Something like that.
Something like that. Quite
Yeah.
multi-billion dollar. Not a trillion yet, but okay. So
And
why?
it's
Yeah, go
and
ahead.
it's a big transaction for BlackRock.
Yeah.
About $12 billion.
$12 billion. So there are issuing shares as well as cash to buy GIP. And why are they doing this? Why does Larry Fink and the team think that infrastructure is the way to go, and how are they going to integrate it with the rest of its business?
There's two elements to this. The first is that alternatives overall has been gaining market share. It's an attractive part of the asset management industry. Alternatives meaning not common stocks and bonds.
Exactly.
So things that you have to, you can't just sell and buy on an exchange.
Private
for
equity,
example.
private debt, infrastructure, mortgages, anything that is less liquid. Of course, they're trying to sell that it has less volatility. Of course, it has less volatility. It doesn't trade every day.
Alternatives over the last decade have been gaining share. Like people have been buying them more because of all the reasons that you've laid out.
As well as low interest rates, right? So
Exactly.
people, bonds are now paying a much better rate of return than they have been for about 20 years. But in a rate environment where you're getting 1 or 2%, and you don't want to have all your money in the stock market and you can't make any money on bonds, obviously you move more money to these alternatives.
And this really goes back to the point that we were making before about those pensions and insurance companies that have specific return targets.
Yeah.
For these investors, alternatives make a lot of sense because they have very long dated liabilities where they know when they're going to have to pay them. And so if you own a bridge, that's an inflation protected stream of revenue.
A toll road, for
toll
example.
road.
Yeah, I mean, it's incredible.
You're not going to need to sell it
Yeah.
tomorrow. So having these cash flows that are steady, predictable, and inflation protected, it makes a lot of sense for these institutions to own.
Why do you like, or why does BlackRock or all of us like infrastructure as an alternative better than all other types of alternatives?
I think the reason why infrastructure in particular is an attractive alternative asset class is because it requires scale. Me and you can tomorrow go out and buy an office building.
I wouldn't want to, but yes, I get your point.
Yes,
Yeah.
you can. It's not that difficult to start a private equity firm to buy some real estate.
Okay.
Me and you can definitely not go out and and start a fund and manage the Gatwick Airport.
Any airport whatsoever. No.
So
yeah.
These are big assets. You need a lot of money to buy them. And more importantly, you need operational expertise.
Also, you need the balance sheet because you have to keep investing, right?
Yes.
It's not, you don't buy it and forget about it. Airports, you have to add more runways, maybe more terminals. The spending is gigantic.
Yeah, and that's really the thesis here is that over the next couple of decades, there's a lot of demand for infrastructure, right? Everybody wants to invest in infrastructure. Every politician's pitch is we're going to build infrastructure.
For sure.
But the problem is that governments around the world, they have a lot of debt. Like they took on a lot of debt and they're running deficits.
We're all screwed. The debts are gigantic in every single country.
So they're going to have to find private capital, such as infrastructure, private equity, to fund these projects.
To become partners. Maybe if the country is in debt and they want to reduce some debt, they would sell the infrastructure to a GIP, for example. Yeah, everybody wants to invest in infrastructure. We live in Canada. We need more hospitals. We need more apartment buildings. We need better roads.
Yes.
Where's all this money going to come from? Meanwhile, all our cities are bankrupt.
And what's interesting about this deal is that BlackRock actually did already have an infrastructure business, but what they lacked was the capabilities to manage large-scale infrastructure equity. And this is what GIP gives them.
Yeah.
So now they can go out and bid on mega projects and have both the funding available as well as the operational expertise to manage these projects. And I think it's another fantastic business that's going to work out very well for them.
And of course, now, Ernest, they can make products to sell to retail and institutional investors around infrastructure. You want to get some exposure to infrastructure? Here we have an ETF or some kind of liquid fund or maybe non-liquid fund that you can invest in that gets you that exposure. And are you going to trust a small little company, or are you going to trust the biggest asset manager in the world with a great track record?
Yes.
So now BlackRock with this deal becomes the second biggest investor in infrastructure, private equity. Who's number one?
It would be Brookfield.
Brookfield. Brookfield at Bruce Flatt he saw the future well before Larry Fink did.
Yes, and what's really interesting about this deal is that while we like it for BlackRock, the thesis is entirely what Bruce Flatt has been saying for the last forever.
Bruce Flatt, the CEO of Brookfield?
Yes. He was out there talking about the needs for infrastructure spending from private capital for the longest time. And the fact that an increased amount of these projects and capital is going to go to large companies because they're the only ones that have the funding and the scale to be able to manage these assets. And so, in our opinion, I think this is very positive for Brookfield as well.
Did you notice, of course, so BlackRock is buying an alternative asset manager and infrastructure. Brookfield, which already is the largest, is getting into the insurance and annuities business to sell those clients Brookfield products, primarily infrastructure. So it looks like going forward, there's going to be a lot of alternative products to retail and institutional investors to get access to infrastructure.
Yes.
It'll be very interesting to see how that goes. Any last thoughts or final words you want to say about BlackRock or Brookfield for that matter?
No, I think one question that some people might have is, well, if infrastructure is so attractive, why don't you guys own any, right?
Oh, us?
Yes.
So answer that question.
I think it's a fair question. But again, we are owning infrastructure by owning BlackRock and Brookfield.
Exactly. We're partnering at the top of the food chain. Why do I have to put our clients into something that's illiquid?
Yes.
That they're locked into, that's not transparent, when I can just be partnered with Larry Fink and Bruce Flatt at the top and get my exposure that way? Yes, we're going to have volatility with the stock market, but if there's more infrastructure deals to come in the future, I think we're going to do very well owning these types of stocks. So that's all we have for you today. Thank you very much for joining us, and we'll see you back here real soon.